major trends of financial regulation, the European Union governance of financial supervision, and what to expect from banking union and a renewed capital markets union in the context of crisis and safeguard of financial stability. In fact, not much longer than a decade after the last so-called great financial crisis, a new and dramatic crisis has unexpectedly erupted. And this crisis bears in common with the previous one a daunting perspective of systemic risk and of destruction of wealth and employment. Conversely, a distinctive feature of this crisis concerns the sheer level of uncertainty and the extreme technical difficulty in producing reliable projections. Such difficulty has in itself a spillover effect in terms of overall confidence, which in turn is bound to have significant repercussions in the financial sector, especially the banking sector, whose activities are fueled by the levels of confidence of stakeholders in the sustainability of the most relevant parts of the sector and of the economic activities supported by the said sector. Another distinctive factor is that the current crisis involving combined demand-side and supply-side shocks is a paradigmatic illustration of systemic risks working powerfully outside the banking or financial sector, to which, I should say, very little attention has been paid over the last decade. Actually, it may be assumed as consensual that there are no forces of systemic risk originating in the financial sector fueling the current COVID crisis. In other words, considering the usual characterization of financial risks as endogenous and exogenous risks, the COVID shock is absolutely exogenous. However, this does not mean that the potential for endogenous risk amplification will not come to exist within the financial sector, although the trigger is at the start an exogenous shock. In a nutshell, and to put it in simpler terms, it is of vital importance to prevent too prolonged and intense exogenous risks originating in the rest of the economy, affecting the financial sector and especially the banking sector, that could generate some form of uncontrolled amplification within this financial sector, and in a second stage, produce what would come to represent a true systemic financial crisis, also building on remaining vulnerabilities of the banking sector, especially in the European Union, in spite of the significant and undeniable progress arising from regulatory and supervisory reform and the building of the banking union and related instruments. From another and more positive perspective, the financial sector is bound to play a fundamental role in the economic responses to the current exogenous shock. But for that to happen, it is absolutely essential to prevent the so-called endogenous risk amplification effect within the financial sector, which would have disastrous consequences. In this critical context, an extensive array of measures and actions have been developed in the European Union, especially in the Eurozone, building on the new European financial supervisory infrastructure created in the wake of the previous crisis and partially correcting the previous gaps in financial integration that were a major initial imbalance of the Eurozone. I shall not deal here in these introductory words, setting the scene for the conference with any kind of review of such measures, namely of the single supervisory mechanism within the ECB, the single resolution board, the European supervisory authorities, ESAs, or the European Systemic Risk Board in conjunction with the European Commission. These bodies, integrating what I'm loosely calling here the new European financial supervisory infrastructure arising from the last crisis, these bodies are largely represented here at the conference, and therefore we shall have ample opportunity in the course of today to discuss the multiple inputs they have been providing as from last March to stabilize the financial sector. In this context, if I could try at this introductory stage to summarize our chief goals today, these will include: one, to identify and critically discuss the key trends and forces at play as regards the financial sector, especially the subsectors of banking and of capital markets. And two, to perceive the mix of positive and negative dynamics unleashed by the COVID crisis. And this in itself also explains, in an European context, the very intentional focus of the conference on the building blocks of the European Banking Union and its critical missing pieces, and on the potential pieces of a new legal, economic, and institutional puzzle of a truly reinvented capital markets union after a clear failure of the first project or ideas on capital markets union. A focus which has led us, in the somehow constrained online format of this year conference, to prioritize, in terms of Portuguese scientific partners, the involvement of the Bank of Portugal and of the Portuguese Securities Commission, CMVM, which on behalf of our research center, CIRSF, I acknowledge and I thank heartily, addressing this recognition to the Governor of Banco de Portugal, Mário Centeno, who will close today's morning proceedings, and to the President of the Securities Commission, Gabriela Figueiredo Dias, with whom it is a privilege to open this conference in the morning session. If I may add an extra word in terms of what I'm designating here as a much-needed reinvention of a consistent capital markets project, the report of the High-Level Forum on the Capital Markets Union of last June, the Capital Markets Recovery Package proposed by the Commission in July, and the recent September report of the European Parliament on further developments of the Capital Markets Union represent welcome developments, but which are still very far from what would be necessary and desirable in this critical field. Allow me also to refer that if the potential negative dynamics for the financial sector arising from the current crisis are widely commented, we should try to look ahead and to put in perspective positive opportunities of transformation for the financial sector. As regards banking, we may consider a possible acceleration of digitalization due to the adaptation required in these times of increased digital interactions. This prospective accelerated digitalization is bound to be combined with an adaptation of the banking business model involving new forms of interaction with clients and also new market incentives to banking consolidation. In fact, while it is widely acknowledged that significant hurdles remain in the European Union as regards further banking consolidation, for a variety of reasons that EBA has recently analyzed right before the eruption of the COVID shock, the almost inevitable constraints which will affect some more fragile banks may lead to a virtuous cycle of market-oriented bank consolidation, which, in my view, is much more positive than any type of regulator-induced consolidation. At another level, an efficient response by the banking sector to the current situation of distress, taking full stock of all the supervisory and foreseeable public mechanisms to be put in place in order to anchor a continuous support of banks to their client bases, may produce, I should say, a complete overhaul of the negative legacy in terms of business and cultural image that had resulted from the previous great financial crisis. As regards the capital markets, it should be stressed that the sector's resilience has been evidenced in the most acute moment of the crisis, in March, April, with market infrastructures remaining open and receiving, although with high levels of volatility, record volume of equity trades. Also, as it has been stressed by various regulators, funds which were considered vulnerable in the stress simulations produced by ESMA and the European Systemic Risk Board did not face the problems that were feared. But again, it should be underlined that in Europe, a lot has to be done to ensure a more robust role of capital markets in the financing of the economy and financing the potential recovery, while ensuring at the same time conditions of financial stability for those capital markets. Allow me now some very brief words and final words to flash or highlight the areas we shall be covering during the conference. After the intervention of Gabriela Figueiredo Dias in this initial session, focused on capital markets, financial stability and supervisory convergence, we shall have a keynote address by the Vice President of the European Central Bank, Luís de Guindos, to whom we are very grateful for intervening again in the conference in the wake of his presence with us in 2019, then physically in Lisbon. He will be touching precisely issues pertaining to where we stand now in terms of banking union and capital markets union in the context of the pandemic crisis, so excellent food for thought, I would say. We shall turn then to our first panel with Boston Yazbek from the board of the Single Resolution Board, Christos Gortsos, the president of the Academic Board of EBI, a key scientific partner of this conference, and Elena Carletti from Bocconi University and the Florence School of Banking and Finance, which is another scientific partner of ours. This panel will discuss critical challenges in the enforcement of the resolution regime in the now prevailing conditions, but also trying to look forwards, besides addressing other issues related with financial stability, debating, time allowing, key issues of profitability for banks, and even the evolution of the business model of banks. We shall then close the morning with a keynote address of the Governor of Banco de Portugal and former President of the Eurogroup, Mário Centeno, focusing on the challenges of a sustained and inclusive economic recovery, thanking him heartily for his availability for this keynote address. After the lunch break, we shall start, I would say, with the most stimulating panel, in which we have the privilege of reuniting the three chairs of the three ESAs, EBA, ESMA, and IOPA, discussing from a cross-sectoral perspective the role of ESAs in the current context, which is simultaneously a context of crisis and of possible further European Union integration of financial supervision, also in the wake of the review of the regime of ESAs in December 2019. In a debate which will be moderated by Pedro Gustavo Teixeira from the SSM, who has been a great supporter of our CIRSF project and to whom I want also to publicly thank for that. Then, the afternoon proceedings will be completed with a presentation by Luís Máximo dos Santos, Vice Governor of Banco de Portugal, touching on market conduct supervision as a good reminder of the sometimes overlooked key interplay between prudential and market conduct supervision, to whom I also want to thank all the continuous support of the bank for our scientific project. And lastly, but not least, we shall have a final panel with Ana Paula Serra of the board of Banco de Portugal, in charge of prudential banking supervision, and Mário Nava from the Commission, more specifically from the Directorate General of Structural Reform Support, and previously at FISMA, Financial Services, and so in a pivotal position to discuss new European Union initiatives oriented towards fostering economic recovery and its contribution to financial stability, in what I believe will be a most stimulating combination with Ana Paula Serra focus on adequate banking supervisory strategies in the current times and remaining pieces of the banking union, all aimed, I should say, at the safeguard of financial stability. So we will close the circle and we'll end at the end of the day as we started with this focus on financial stability. I wish you all a good and productive conference, and without further ado, I would give the floor now to Gabriela Figueiredo Dias, the President of the Portuguese Securities Commission. Many thanks.
To start by thanking Professor Luís Moraes for this invitation and for the initiative and for bringing together such a distinguished group of speakers and panelists, even even in these very difficult circumstances. I must say that Professor Luís Moraes made my life with his introduction a little bit easier or harder, I don't know, because I think that we are so much aligned in some of the topics that I would be released from saying part of what I was going to say. But anyway, thank you. And we did not speak, I can tell you. So it seems that we have prepared together, but it's not true. And so once again, thank you for this opportunity anyway, in these times where we are being so strongly requested to join efforts and to tread this recovery path alongside this project, the CIRSF project, while bringing together regulators to reflect together about the financial stability and financial system is more important than ever. So these are indeed difficult times. In recent weeks, as we all know, the surge of the coronavirus infections has led to a worrisome situation, and the turning point of the fight against the pandemic is not yet visible. As a consequence of the sanitary crisis, the social and economic impacts are striking and long-lasting, even if the very recent news on a possible vaccine is shedding some faith on the future. In the first half year of 2020, the pandemic outbreak and associated lockdown measures took a severe and unprecedented toll on the European economy. The rebound, which began in May, is now facing new difficulties with the reintroduction of severe restrictions. Impacts were different across member states, and Portugal is certainly an economy that has been heavily impacted. The forecast for Portugal is worse than that for the euro area in 2020, and the uncertainty about when will the numbers of coronavirus infections in Portugal start to decrease renders these forecasts even more uncertain. After the March turmoil in the global markets, summer brought some good news. Inflows to the funds industry increased and equity markets recovered partially, and in some jurisdictions even more than recovered from the pre-summer lows. Credit spreads adjusted to median levels and debt costs fell to pre-crisis levels with significant bond issuances across sectors. But since September, and more crucially in October, the market mood changed somewhat. The new pandemic wave triggered a strong increase in volatility back to June levels, and we have observed significant declines in stock markets in several jurisdictions and a slight increase in the outflows of funds at European level, including money market funds. The developments of the last weeks are a stark reminder that even with the massive monetary and fiscal stimulus that prevented a global depression, we are still facing a rather economic and financial uncertainty. The heavy toll the pandemic will still have on our social fabric, as well as on health and social security systems, is a good example of that uncertainty. And so is the decoupling of market prices from the real economy. That is still to be fully explained and might result in significant adjustments. In this context, credit risk is expected to increase, reflected in corporate bonds downgrades and business bankruptcies, as more restrictions are being imposed in response to the second wave of the pandemic. It is also foreseeable that the level of non-performing loans held by the European banks will increase in the coming months, further affecting bank profitability and ability to continue funding the real economy as needed. Given the level of the challenges ahead, strong and smart policies are needed to enhance the contribution of the financial system to the recovery, in particular to take advantage of market instruments to diversify risk and financing options for companies and offer better saving alternatives to families. Capital markets may and should have a significant contribution to the recovery, also because banks will not be able to provide all the funding needed to overcome the pandemic and set in motion a growth strategy. In particular, capital markets can offer funding for activities and entities that would traditionally not be served by the banking sector, like innovative businesses and small and medium companies. They can attract institutional as well as retail investors and transform their money into funding opportunities. And by doing so, contribute significantly to innovation and the competitiveness of the European economy and the wealth and welfare of its citizens. But can we truly be optimistic as to seeing a valid contribution from capital markets to the long-term economic recovery? Can we expect the markets to steer that recovery into a new direction where digital, environmental, and social dimensions are effectively considered and supported by proper governance? Not surprisingly, my answer is yes, we can. But it takes some conditions and comes at a price. We need to provide simple and attractive products to families and companies, offered by well-governed entities and respectful, to say the least, of environmental, social, and governance concerns, to reduce the risk of financial and supervision fragmentation, and to earn the trust of our fellow citizens. The Capital Markets Union Action Plan, alongside other initiatives such as the European Sustainable Finance and the FinTech Action Plans, are timely and important steps in the right direction. But their success will much depend on the attractiveness of the market alternatives offered to the families and the community, as well as on the trust in capital markets that we are able to build. For that purpose, European capital markets are very much focused on offering products that are properly designed, comparable and transparent in terms of costs, risks, and returns, and that offer returns adjusted to investors' profiles and expectations. Products that are sold and advised bias-free by competent and compliant professionals. Product governance, fees and cost transparency, and mitigation of conflicts of interest at all levels are key elements of attractive and reliable capital markets. On the sell side, European companies need to risk investing in innovation and long-term structural projects to attract talent and to foster competitiveness. But we also need innovative vehicles or structures different from banks and prone to capture and aggregate great amounts of funds and channeling them to small and medium enterprises, ensuring that available liquidity and projects in need of funding meet each other. Finally, the underlying element in the successful provision of innovative and adjusted services and products must be professionalism, based not only on technical but also ethical rules, allowing for the proper consideration of the client's interests and of all the involved stakeholders. In a nutshell, we need sound business models and fit and proper top executives that stand on strong values and ethical principles, solid professionalism, and appropriate board and governance culture. This is the only way to generate trust and recover confidence. Regulation and supervision are decisive instruments in the development of competitive and efficient capital markets that European citizens can trust. And although much remains to be done, the good news is that much has been done in the last years and that we actually have the tools to act. More than developing new rules, the challenge is more one of strengthening supervisory convergence and maybe even, in very limited cases, of centralized coordination when financial stability is at stake. While investors' trust in capital markets depends on a critical cultural change in companies and on fierce adherence to the highest ethical and quality standards, it is important to note that current regulation already allows regulators to assess and act on boards' culture, effectiveness, and integrity. These rules may and should be strictly enforced, and the European Central Bank deserves high regards for the work done in this respect since the crisis. On another front, offering adequate products, providing alternative funding solutions to companies, and contributing to financial stability in the European Union surely takes well-supervised capital markets with a proper single rule book and enhanced supervisory convergence. Supervisory convergence is not only essential to ensure a level playing field, but also to ensure confidence and strategic alignment between markets and jurisdictions and a true union of European capital markets, making Europe consistent and robust unreliable to households and to companies amidst the market's ebbs and flows. In this regard, ESMA has been playing an undeniable valuable role, which has been recently enhanced by the new tools, powers and responsibilities arising from the European Supervisory Authority's regulation review. The definition of Union strategic supervisory priorities that the national supervisors shall take into account in their annual planning. The European Supervisory Handbook that ESMA is starting to develop. The heat map, whereby the main European supervisory risks and priorities are annually identified, or the common supervisory actions by which all national supervisors are already launching simultaneously supervisory actions with the same scope, criteria, and methodologies are relevant and innovative tools towards alignment and consistency, building on the contributions from all member states. In parallel, ESMA has gained new direct supervision powers on systemically relevant third country central clearing counterparties, so-called CCPs, on European critical benchmarks and on the administrators and data service providers, alongside with the already existing direct supervisory powers on credit rating agencies and trading repositories. This is, however, just a small fraction of the entire universe of entities and activities under supervision. Central direct supervision or a banking union-alike model is not, or at least not yet, the foreseen evolution of the roadmap for capital market supervision. However, I believe we need to continuously assess the resilience of the existing European market supervision model based on national supervision authorities to the changing nature of the risks, in particular when the European financial stability may be at stake. We need to keep proximity as a means for better understanding the market and its particularities, national specificities and cultures. But we also must tackle inconsistencies that are detrimental to integrated markets and financial stability. To this end, the new Capital Markets Union plan rightfully requires the Commission to consider proposing measures for stronger supervisory coordination or direct supervision by the European supervisory authorities. One way or the other, it is certain that where the option for national supervision is kept, fully harmonized interpretation of rules and coordinated and convergent supervision are fundamental conditions of the market. In addition, a growing focus of markets regulators on prudential and macroprudential supervision is absolutely key and already being embedded in our mandates and strategies. This is also contributing to dilute the classical, unnecessary, and detrimental tension between prudential and market conduct supervision and between micro and macro responses, paving the way for an integrated and holistic capital market supervision model, irrespective of its institutional structure. But one important thing that I would like to leave very clear in this forum of financial regulators is that financial stability is becoming a central part of market regulators' agenda. Consequently, new specific approaches are needed to properly regulate and supervise capital markets under such a perspective. In fact, capital markets will only be a real complement to the traditional banking financing by equipping the financial system with a larger capacity to absorb while not creating new relevant systemic impacts. The sudden, impactful and quick shock that occurred in March this year was a real-life stress test for many market entities. Although in general they successfully passed the first COVID tests, much work must be done based on the evidence collected from the reaction to the shock in order to reinforce their capacity to contribute to financial stability. This is exactly what we are already doing at the CMVM and at the ESMA level, in particular at the Investment Management Standing Committee that I'm honored to chair, also in response to the ESRB recommendation on investment funds liquidity that should be published by today. While the jury is still out on what might be the needed adjustments, any answer should adopt a balanced approach that assures sectoral appropriateness, calibration, and proportionality of possible initiatives, while searching for effective combinations of supervisory and enforcement measures whenever possible, instead of regulatory changes. Indeed, and notwithstanding very specific amendments that may be required to improve our regulatory framework, we should prioritize harmonized supervision and enforcement practices as a means to promoting stable and orderly markets and enhance investor protection. Simply importing bank-like solutions that are not suitably adjusted for capital markets would be the wrong way to go. This would affect the efficiency of this sector and prevent it from being a viable funding alternative of increased relevance, namely in crisis contexts, which ultimately would affect financial stability. So again, the way forward should be to provide and make use of a market-specific, tailor-made toolkit for market participants and regulators to address financial stability issues. With that purpose, capital market supervisors, being fully aware of the risks posed by and inflicted on the capital markets, are following a hands-on approach in the creation, by design, of an appropriate macroprudential framework and specific tools that will deliver proper risk prevention and mitigation. The financial stability objective, and to put it more broadly, the development of efficient capital markets in the European Union, can only be achieved through a constructive dialogue across sectors, cultures, jurisdictions, and institutions. Relevant and granular information and thorough analysis must be continuously shared. We will not have integrated and stable markets in Europe unless we work in an integrated manner. This also means that ESMA, EBA, EIOPA, ESRB, and the ECB, and needless to say, CMVM, Banco de Portugal, and ISCF, must work alongside towards the common goal of promoting a strong and dynamic financial system that can foster growth across our economies and be at the service of our fellow citizens. Cooperation is thus key. And this is why CIRSF initiative and this conference, while bringing us all together, is so important. Thank you very much, Luis, for the initiative. Thank you very much for the invitation, and I wish you all a good day of debates. Thank you.
Many thanks, Christiana. Many thanks. And now, without further ado, I would give the floor to the Vice President of the ECB, thanking him again for his availability. Thank you.
Good morning, everyone. It's a great pleasure for me to open this virtual conference on major trends in financial regulation. I hope next time we will be able to do it in person in Lisbon. Hopefully. I hope that we will be able to do it. Let me start with one question. Where could we be today if we had not improved the governance framework and policy toolkit in the aftermath of the 2008 financial crisis? Imagine if the euro area had to face the coronavirus pandemic without single banking supervision, common resolution arrangements, higher capital requirements for banks, an organizational framework enabling swift decisions on crucial policy matters. Indeed, we have been seeing the benefits of the post-crisis reforms throughout the COVID-19 crisis. Banks' capital resources have substantially increased since the creation of the banking union. Liquidity ratios have also risen and remained strong over the same period. And the fact that crisis-related decisions were taken at banking union level has enhanced the coherence, consistency, and coordination of our response. This has been essential in ensuring an effective response and avoiding a patchwork of national measures with pronounced fragmentation along national lines. But we need to do more to help us rebound from the current crisis and secure an even better and more resilient future. As you know, the ECB is a staunch supporter of the Banking Union and the Capital Markets Union, two central policy initiatives aiming to catalyze financial integration in the European Union. Advancing these financial sector reforms is not only good for financial institutions, market players and investors, but will benefit all of us as Europeans. The more we integrate and develop EU capital markets, the more we will support a robust and uniform recovery across our economies, along with the transition to a low-carbon, sustainable and digitalized economy. And completing the banking union by establishing a common deposit insurance scheme would ensure depositors are equally protected across member states and preserve their confidence if we were to face turbulence. Let me first say a few words on the current situation in financial markets. The coronavirus pandemic continues to have a major disruptive impact on the economic and financial environment. Governments are taking new measures to contain the virus, and the pandemic is still weighing on the outlook for financial stability. Vulnerabilities in the financial sector include public and private debt accumulation, increasing prospective credit losses, and weaker profitability in the banking sector, and greater risk-taking in the non-bank financial sector. All of these vulnerabilities, which I will now address in more detail, warrant close monitoring. First, massive fiscal support has preserved production output capacity so far, but has also led to sizable budget deficit for 2020. As the new wave of the pandemic is weighing on the recovery, it is important that this support is maintained and in some areas even scaled up in the coming months. If support measures end too soon or too abruptly, the shock to firms and businesses would be severe. Over the medium term, however, decision makers will need to carefully manage the exit from the extraordinary fiscal measures, balancing the risk of cliff edges against the risk of overly prolonged support in order to ensure the longer-term sustainability of public debt. Second, euro area banks saw the return on equity decline from over 5% in the fourth quarter of 2019 to just slightly above 2% in the second quarter. This trend was predominantly driven by banks making higher loan loss provisions and having less capacity to generate income. Looking ahead, bank profitability is expected to remain weak and not to recover to pre-COVID levels before 2022. Banks are stepping up cost-cutting efforts, but may still need to consolidate in response to this development. Third, we have seen investment funds taking on more exposure to longer duration and lower-rated debt issued by non-financial corporations, increasing the likelihood of outflows and losses if corporate credit risk rises materially. Liquidity risk in funds has also started to mount up again. In parallel, we see signs of greater risk-taking by insurers too. These vulnerabilities remind us that we cannot afford to be complacent. We need to take bold steps to support the recovery and further develop and integrate our financial system, thereby also relieving public finances, helping banks with their profitability issues, and boosting financial system resilience. So, what exactly do we need to do? Completing the banking union is a major priority. First, it is now crucial to make the common backstop to the Single Resolution Fund operational. This backstop, provided by the European Stability Mechanism, will further enhance credibility and confidence in the resolution framework. Second, we urgently need several targeted changes to further improve the framework for dealing with banks in crisis. For example, we need to strengthen the crisis management framework for small and medium-sized retail banks. The solution may pose challenges for these banks, whose business model may make it difficult to issue sufficient amounts of liabilities that cannot be bailed in. And as liquidation frameworks currently differ across member states, it will also be important to promote convergence for bank insolvency procedures so as to ensure consistency in the treatment of creditors. But aside from the SRF backstop and the targeted changes to the crisis management framework, today I will focus on the key missing elements of the banking union. A common European deposit insurance scheme. Regrettably, we have made little progress on this front. Let me briefly recall why ANIDIS is so important. First, without ANIDIS, depositor protection remains dependent on bank location and on national deposit insurance schemes. This could distort the level playing field if national funds are exhausted. Governments are likely to provide the backup support, and the differences in fiscal strength across member states could report in differing levels of depositor confidence. Second, national deposit insurance funds could be depleted more quickly than a larger and diversified European fund, in particular in the case of a local shock. Continuing to rely on national schemes could exacerbate the bank sovereign doom loop, given that public finances might be used to backstop national funds. Third, a misalignment persists between centralized bank supervision and resolution in the banking union, on the one hand, and national deposit insurance on the other hand. With an EDIS, all three functions could be aligned at the banking union level, helping to ensure consistency. Clearly, the reasons in favor of an EDIS were already relevant before the COVID-19 crisis, but they have become particularly important now. Particularly at this juncture, we need tools to enhance confidence in the banking system, preserve financial stability, and avoid exacerbating the bank's sovereign doom loop. EDIS would significantly contribute to all these goals by ensuring a uniform protection of depositor across member states, reducing the likelihood of bank runs through a confidence-enhancing mechanism, and thus avoiding potential vicious spirals that aggravate negative shocks in individual member states. Creating a genuine capital markets union is a second major priority. At this point, a single EU capital market is no longer something that is nice to have, but that we need to have. Let me explain. First, while we should be realistic that some measures will take longer to yield noticeable benefits than others, a more developed capital market union is key to funding the post-COVID-19 recovery, as private funding from the capital markets will complement public funding and bank funding, both under pressure from the pandemic. This will also help limit the risk of growing asymmetries among euro area countries in the recovery from the COVID-19 shock. Second, capital market union could improve and diversify funding conditions, creating prospects for jobs and growth, including a more sustainable and digitalized economy. A second round effect of this is that people and firms will have access to a broader range of investment opportunities, helping to improve return risk trade-offs in their savings and investments. Finally, better developed and integrated euro area capital markets could strengthen the international role of the euro, as deep and liquid domestic financial markets are fundamental to a currency's ability to attain and expand its international status. It would also help to build a stronger European financial sector, enabling it to meet the challenges created by Brexit, in particular in areas where the EU now strongly relies on the London financial centre. The path to completing capital market union still presents several challenges. Progress is still needed in many key areas, including harmonising taxation and corporate insolvency regimes, and moving towards a single EU capital market supervisor. Success in these areas would mean more cross-border investment and funding, lower administrative burdens, and lower funding costs. Achieving a fully fledged capital markets union overseen by a single supervisor would also acknowledge that risks do not stop at the EU's internal borders. The Commission's new action plan on capital market union is a step in the right direction. We will play our part in fully supporting the capital market union agenda in the months ahead. Allow me to return to the thought I shared at the beginning of these remarks. After the previous crisis, we took significant steps to make our financial system more resilient. In the face of another major crisis, we need to take similarly bold steps. We need to complete the banking union and fulfill our commitment to building a fully fledged capital markets union. This will take a heightened level of political will and ambition from all sides in the EU, but we need to rise to the challenge. The price of inaction, if you allow me to say, is too high. Thank you very much.
Many thanks, Mr. Vice President, for a most stimulating presentation. And again, I thank you heartily, being aware of your overburdened agenda. And also, I hope that physically next year we'll have the privilege of commenting the new developments in 2021. Many thanks. Many thanks.
I hope to see you again, in person next year. Thank you very much.
Many thanks. Many thanks, and see you soon. We shall have a short break now, resuming with the first panel at 10:30 Portuguese hour and 11:30 Central European time. So in about 20 minutes, we shall start the first panel. Thank you. Let me start by thanking the three of you within your overburdened agendas to be available for this discussion and this first panel in the morning in our conference. I think that our three speakers do not need any kind of presentation, so I'll be extremely short in the interest of time and in the interest of discussion. We have to discuss in this first panel with a very broad topic, so which allows lots of perspectives for discussion. Current challenges in the enforcement of the resolution regime and financial stability, which allows other avenues for discussion. And we are fortunate to have with us Bostian Yazbek. Good morning, Bostian, from the board member of the Single Resolution Board, so at the center of the topic. Christos Gortos, my good friend Christos Gortos, who happens to be the president of the academic board of the EBI, who is cooperating with us in this initiative, and also a professor of Capodistria at University of Athens, beside other academic affiliations. And Elena Carletti, buongiorno, good morning, from Bocconi University, and also from the Florence School of Banking and Finance, which actively cooperates with our research center. I think the sound is good, the image too. So what I would start within this broad topic would be to ask you for some initial words, some initial thoughts on this topic, focusing either on the enforcement of resolution regime or on critical issues pertaining to financial stability nowadays. I would perhaps follow the order of the program, and in this initial round of statements, then proceeding immediately for the discussion, I would follow the order of the program, and I will give the floor initially to Bostian, thanking him again. Bostian, the floor is yours.
Thank you. Good morning. Thank you, Luis, for inviting me to this very interesting event. Looking forward to come to Lisbon, but unfortunately, we will have to postpone this for any other time. Though the latest news are rather encouraging in a way of maybe really getting together in person, rather sooner than later. But let's see what happens. In between, many things have happened. As much as we've at least from the resolution planning perspective and the work that we are doing at the Single Resolution Board in Brussels, we've planned the work accordingly, and then we're trying to unfold the work that we are legally obliged to do, namely to design the resolution plans for all the banks in our remit and determine the annual decisions that are pertaining to every single bank in our remit. As you know, the SRB is directly responsible for more than 120 banks that we share the common platform in terms of the direct responsibility with the SSM. And we do coordinate all the other work for less significant institutions that are still in national domains across the banking union. So to put and then to use this couple of minutes of my introductory remarks, I'd say that we are duly exercising and executing our role as the second pillar of the banking union, the first being the SSM, the second SRB, SRM, and of course the first one that is still missing, the common deposit guarantee scheme. In this context, we are still busy finishing the framework of the second pillar, which unfortunately is still work in progress, and then I'll talk about that later in my introductory remarks, and of course if there are any questions after when we get into our discussion. So for us now, the most common priority is indeed finishing the development of a full resolution plan for every single bank under our remit. with a sound and reasonable and of course legally binding MREL decisions in this respect. In addition to the field work that we are doing in direct relation with our banks, of course, there is this part that goes by name of Single Resolution Fund, which enable us to do the resolution related actions when they need it. The fund goal is to reach 60 billion, around 60 billion by 2023, and we are in a solid way and a rather justified way in getting there as planned. So to make my introductory remarks points of further discussion in this respect, I would single out 4 challenges that I see as the ones that might come to our table and table of our political masters in this respect in the following months or in nearest future. First, of course, is the challenge to complete what we have started since the last financial crisis. We have to understand that financial crisis 10 years ago, we were not equipped to deal with the consequences of financial crisis with institutions like SSM and SRB as we are today. So in this respect, one might claim that we are better equipped to deal with the potential consequences of the crisis that might grow out of the health crisis that we face today. So completing what we started means we need to put additional efforts into finishing the common European scheme for deposit insurance and protection, namely the third pillar of the banking union. It is second, we need to provide the common backstop to Single Resolution Fund. That is a work in progress, still with rather unfavorable consequences for some. Some still believe that there is no clear understanding of how this common backstop would work, and that is still some work to do there. Then third is, of course, we need to continue working on fit for purpose completion of the capital markets union, which will, of course, also reflect into something that banks are dwelling today, namely the MREL issuances that would, of course, be supported by properly functioning capital markets unions. And the fourth, which is at the arm length, and which might be rather substantial in terms of any potential unfold of the financial crisis now, is harmonized insolvency regimes across 19 banking union members as of today. So this is the first set of challenges, which are most of the legislative regulatory framework. The second challenge that I find important to be fully addressed is, of course, that banking industry, banks themselves, continue to meet their obligations in building resolvability. First is, of course, the build-up of MREL as immediate weapon or means in fighting the potential resolution challenges when they are needed, and of course the broader perspective of resolvability of the banks, meaning the substantive impediments procedures, the financial markets infrastructure, access, operational continuity, and there is still a lot of work there to be done from the banking perspective. Of course, banks feel constantly strained and under pressure of continuing with this work, but this is indeed the cornerstone from the industry perspective in order to make the banks indeed resolvable. Third challenge that I see as now immediate challenge, and which is something that a year ago we haven't even thought about it, is of course that most of the banking union members introduced the government set of measures in order to prevent the immediate effect of the health crisis. And those measures stemming from the guarantee schemes to direct forbearance measures would at some point cease to exist, and we all observe, closely monitor the set of measures that would need to be withdrawn in order to put the framework back to maybe new normal, but at least those measures would at some point cease to exist. We need to be fully aware of those measures first, and second, more importantly, we need to be aware of the consequences when the measures are withdrawn. And this third set of immediate challenges lead me to the fourth and final point, and in this introduction, namely the growing volume and number of non-performing loans and exposures in the banks. This is, of course, a bit related to the previous set of challenges that I see, because some of the bad loans or non-performing exposures in the banks are masked, are disguised by the government set of measures. But this would indeed require the joint efforts from first and second pillar of the banking union, namely the SSM from supervisory perspective, and the SRB from resolution perspective, in a way of dealing with those measures at time. As an English saying and proverb says, and it goes, "A stitch in time saves nine." This is indeed something that we need to be there. We need to be hands-on, and I don't understand those who are ex ante dismissing the options like a bad bank, like the network of the European banks as unnecessary. Why? Because I do believe that in some countries the asset management companies as a vehicle to offload the bad assets were indeed substantially contributing to the good resolution of the outcomes in some countries. Portugal is one of those countries. The country I come from, Slovenia, is one of them. Ireland is one of them. Spain is one of them. So there are good practices there that we indeed should put in practice. Of course, the big question is, who pays for all this for these different enterprises? And here I come to the conclusion of my initial remarks, namely, we need to keep in mind why the resolution framework had been put in place 10 years ago. Two reasons. One were, of course, the reasons of financial stability, which means to improve the resilience, the robustness, and address the interconnectedness of the banks. And the second one, which in my view is becoming more and more visible, though very few would like to acknowledge, is the political reason of why the resolution regimes are there, and this is to protect the taxpayers for being again asked to contribute to sort the issues in the financial industry. Those political reasons are, at least in my view, the best summarized by saying, as long as it happens at somebody else's backyard, let's stick to the framework, but when it starts happening in your own backyard, let's find the ways to avoid and try to bypass the resolution regime that, at least in this point, and here I stop, lacks the adjective European, We are rarely talking about the European resolution regimes. We are, of course, in the conferences like this and in the nice papers written, always very keen on talking about the European resolution regimes. But when it gets to the solutions, but unfortunately, at this point, we are still rather biased toward the national ways of sorting out the potential crisis that it happens. I stop here. And thank you.
Many thanks, Bastian. And we have lots of food for thought in your 4 challenges, to which I hope to return during the discussion. But I would now give immediately the floor to Christos for his initial considerations, and then afterwards to Elena. Christos, the floor is yours.
Thank you very much, dear Morais, and it's great pleasure. I'm sitting in this panel with Bastian and my dear colleague Elena Carletti. Speaking about financial stability and the crisis management framework, I think that the most challenging issue right now would be the one that was already addressed before, and it's relating to the emerging need to address the NPLs problem, which seems to be the elephant in the room. And even though we don't have it yet, the expectations are that after the moratoria will be lifted, the possibility that the average amount of NPLs will increase, differing, of course, among banks and among member states, and the problem will be more difficult to resolve in countries which did not manage, for various reasons, to deal with that problem during the last 10 years. And even though we know that this crisis found the bank more resilient than it was during previous times, before the Eurozone debt crisis, this is the positive effect of the Basel III framework plus the resolution frameworks, which have allowed the resolution authorities, as very correctly pointed out by Bastian, to develop on their resolution planning. Nevertheless, in some cases, the pile of the NPLs remains very high. And across the board, it is expected that it will be one of the major concerns for the months and the years to come. In this respect, I would divide the potential weapons in the hands of the authorities in 2 parts. And the one would be the measures which, according to the existing framework, exist within the supervisory framework, because this is very closely linked to the resolution framework, and then address my own concerns with regard to resolution action and not to resolution planning. When it comes to resolution planning, I think that national resolution authorities and the SRB also coordinating the work of national resolution authorities are very well equipped to do what they have to do. And I think that it is more than manifest that they have declared that even though some flexibility has been applied, there will be no compromise in that front. Even though, as we all know, the MREL rules will become stricter next year, and you will have also the introduction of the TLAC for the large banks, due to the implementation of the BRRD2 and the SRMR2 at the beginning of next year. And at the same time, some requirements, some prudential requirements would also become more stringent, stricter, because of the application of the new framework, the CRR2 and the CRD4/5. So we are in the middle of a period where we have to face the consequences of the pandemic crisis on the economy reflecting then to the banking system, and at the same time, correctly so, a new framework which will contain more stringent rules. Speaking about the supervisory field, yeah, there are three aspects which are of concern. The one has been addressed before. It is, I think, on the top of the agenda, at least of the discussions. It concerns the creation of a bad bank, of an asset management vehicle. The views are diverging, and I'm very much concerned whether a pan-European system could work effectively, at least in the short term. But nevertheless, it is on the agenda, and I think that this would require itself a panel, yeah, to discuss it thoroughly with all the pros and cons, because there are definitely some positive elements into this, and the experience, as correctly mentioned before, from its implementation in several member states is a good indication of how this could work, but at the same time, the risks involved are also significant. A second aspect which is linked to this, and in my view is very important, and not only in my view, is the way that the supervisory authorities will navigate institutions toward the implementation of risk management policies. Because credit risk management is currently one of the most important aspects in the management of banks, to the extent that you need to sort out loans which were performing before, yeah, and may become non-performing, from those who are already in the pile of the non-performing loans. And then again, despite the state guarantees and given the moratoria, yeah, I believe that each credit institution should be very prudent in the way that credit expansion will take place, given the needs of households and at the same time companies of all sizes, not only SMEs, but also large corporates in almost all sectors of the economy. So in my view, risk management and the way that this will be monitored, and I'm sure it is being already monitored by the supervisory authorities, is another critical aspect. A third aspect, which is in my view also important, is the way that the supervisory authorities will make use of their supervisory powers and their early intervention powers, to the extent that this might be considered as a pre-failing or likely to fail stage, correct? And we know that the arsenal of the tools available in the hands of supervisory authorities, according to the CRD4, according to the BRRD, according to the SRMR, you name them, the SSMR, yeah, it's very broad. So this is another aspect which is of importance. And the final aspect which I would like to state with regard to this, which links to the next one, to the resolution actions, yeah, has to do with precautionary capitalization. Because the framework for precautionary capitalization has been used in several cases, yeah. In my country as well, in Italy it has been used, potentially in other countries as well. And I think that the way that this will be applied, some kind of relaxation, but not overstretching of this relaxation, might be useful in order to avoid detrimental conditions for the banking sector. But this again is an open issue, and one can argue in favor or against it. I fully understand the moral hazard issue, yeah, but again, it is on the table, and I think it is of primary importance. Turning now to resolution action, and not to resolution preparation planning, which I understand is more or less settled, I would like to stress 3 points. It was mentioned before, Bostian said that, and we know that we are in dire need of some additional funds for the Single Resolution Fund. And resolution funding is very important when it comes to a situation where a resolution authority will need to apply resolution tools. No matter which resolution tool will be applied, the mission of the SRF, for example, is such that funds will be needed to finance, for example, a bridge bank, or to give a loan to a bank under resolution, and so on. So in that sense, I understand that the steady state for the funds which by ex-ante contributions the SRF will accumulate is still far away. And my question always remains whether these 60 billion euros of steady state funds would be sufficient if you have a generalized financial crisis. And this is of major concern. We know the data, and we know that much more funds would be needed if you were to activate a resolution action for a large, not to mention a very large bank. So in that sense, I have repeatedly questioned whether the need for the SRF would be such that we should already have it in place. So I understand that there are some good developments on that field, but yet again, we have it for 3 years now. And I believe personally that the need for the common backstop is much more needed today than the EDIs, to the extent that, at least in the case of deposit guarantee, you have the national deposit guarantees in place. It would be a huge development if the signaling effect, because mainly it's the signaling effect of the EDIs, would be in place, yeah. But if I were to prioritize between these two measures, establishing the common backstop or establishing the EDIs, if they don't go together immediately, I think that the establishment of the common backstop would add firework, yeah, to the resolution authority, the SRB, in order to be able to efficiently apply resolution actions. Closely linked to this is also the potential contribution of deposit guarantee schemes in resolution financing. This is another aspect which is very important. We know that under our European legislation, there are two primary functions of deposit guarantee schemes. The one, the pay box function, the traditional one, and the second is the contribution to resolution financing. So this might also be an additional element which could alleviate financing problems in case resolution action would be activated. And my final, two final points, I tend to believe that if the resolution board were to apply some resolution tools, the preference for the bail-in tool might not be the optimal one. Good evidence and from previous cases, but in our days, the pro-cyclical negative effects that the application of the bail-in tool would introduce and have would be detrimental to a certain extent for the stability of the economic system, not of the banking system. And we can develop that in the discussion. And my very final point is one of the missing elements of the banking union, which we all acknowledge that should be there, but it's very difficult to implement, indeed, is the harmonization of insolvency legislation. What we have seen during the very many experiences, yeah, in the application of resolution. Let's take the example of the 6 cases where the SRB was involved, not to mention the national ones. At the end of the day, you are living in a union with harmonized resolution tools and harmonize the resolution rules, not to mention prudential rules. And at the end of the day, when it comes to insolvency, you have 27 different solutions. So this part of the equation should also be discussed. I understand fully as a lawyer how difficult it will be. It is not only involving finance ministries, but it's involving so many other players to take political decisions. But yet again, this is an element of our agenda which is missing, and I think that priority should be paid to this. I can stop it here. Thank you very much, and I will be available for the discussion. Thank you.
Many thanks, Christos. Many thanks for a most stimulating presentation or initial words. I would give now the floor to Elena, and I would venture perhaps to ask her if we could broaden a little bit our analytical window and bring into the discussion. We have anchored very much the discussion on the resolution framework, but perhaps bringing to the discussion other key issues for financial stability. But Elena, the floor is yours.
Thank you, Luis, and thank you. Let me also join the others to thank you for the invitation, and I hope you will invite all of us again next year, because we are due a trip to Lisbon. So I already write, tell me when the date is fixed, and I will book my diary to come. Hopefully this will be over. So being the last, of course, many of the things have already been said, but let me, and I'm conscious of the time. So let me restart from the beginning of the crisis and develop a little bit the sequence of what we have seen, because in a way this helps in bringing maybe some aspect that maybe neither Bossian nor Christos hopefully have already touched. So when the crisis started, what was the main priority was certainly to give liquidity and support to the real economy. And we have seen at the beginning the ECB in particular, but providing liquidity to the economy through banks mostly. But then we have also seen a plethora of fiscal measures, the moratoria and the state guarantees that both Bossian and Christos have touched upon. Why is that important? Because the loan guarantees and moratoria have not been homogeneous in any way. They have not been homogeneous in the timing when they have been introduced. At the beginning, there was a little bit of impasse, but also they have been different in the extent of the measures. So it's true, Christos, that we are going to have problems of NPL in countries that had already NPL problem before, and maybe they didn't solve them well. But I think we're also going to see a big asymmetry across countries in particular because of the different fiscal policies that have been implemented. And even now, we see that in some countries, for example, like Germany, moratoria have already expired. And in some other countries, like, for example, Italy, moratoria have just been extended. So it is true that we are going to see similar problems in terms of surge of NPL, but we may see this in different extent and in different timing, depending on the fiscal measures that have been implemented. And I think that is very important. And I would call really for an harmonization of insolvency regimes and so on, but possibly also of the fiscal measures that have been taking place during the crisis, because this created a big fragmentation and asymmetry across banks, but in particular across countries. Now, as you both have said, the biggest threat is the expected potential increase in NPL, and the banks need to prepare for it. So first of all, how banks can prepare for it is, of course, by putting aside provision. The problem is that because there are the moratoria, as it has been said, there is little transparency on which borrowers are effectively in difficulties. And I agree with Christos, credit risk management and monitoring of borrowers is crucially important, but objectively is difficult because of the moratoria. But not even that, is also difficult because there is a big uncertainty in GDP forecasts. So now banks, because of the IFSR 9, are required to put aside provision in expectation of macroeconomic deterioration. But we don't really know how much the macroeconomy will deteriorate. And now with the second wave, we have been a little bit more, been a little bit more positive on the forecast after the second quarter and the third quarter, where we have seen the economy rebounding and much more in some cases than expected. But now with the second wave, we have a new wave of uncertainty. So the moratorium on the one hand and the uncertainty on the macroeconomic development on the other are really challenging issues for banks, even if they would be willing to put provision aside, because in practice, calculating this is very complicated. On top of it, there are no really clear guidelines to banks as how they should do this. So in a way, this boils down to managerial attitude. So there are some banks that can be more risk averse and some banks that are more risk lover in a way, or maybe some banks that can afford provisioning more because they are stronger capital-wise, and some others instead that can afford to provision less because maybe their level of capital is not very high or not high enough. And here I would like to have a little link with resolution, if you allow me. In a way, it is true, and the DBA, the SSM are telling us the system is very strong. The system has a core equity tier 1, which is above 14%. We entered the global financial crisis with a core equity tier 1 that was half almost of this. So in a way, the system is much stronger. But let's not forget that these are averages, and the variance is another story. So I'm a bit worried that we go again towards a situation where all the measures that we take are based on average of the system and not so much on individual cases. And therefore, we sort of prolong the situation where all banks are treated alike. And I am not necessarily in favor of this attitude. Just to tell me an example, I mean, this goes down to resolution because, of course, if you want to go for differentiation of policies across banks, whatever policies we're talking about, you need to be able, the system need to be able to deal with the weaker banks and the weaker financial institution. And here where resolution and liquidation comes into play. So we need to be prepared to deal with the weaker banks. And again, in my view, we shouldn't have generalized policies. I don't think that's necessarily the best way to go forward. Last point, and then maybe we can go back also in terms of how banks provision in the second round. Let's not forget that banks had already existing problems before the crisis. And this is where we want to broaden a little bit. Not so much on capital, because at least on average, they're much stronger. But their weakest side, as also the Vice President of the ECB has reminded us this morning, is certainly the level of profitability. So in Europe, we have a system that is on average highly capitalized, but on average very little profitable. And we see this reflected in stock market evaluation. The stock market evaluation of European banks are much lower than the one of US peers. There are various reasons for it, one being the NPL, the legacy of the NPL, one being the problem that we had a sovereign debt crisis. But I think that is an issue that policymakers should clearly address. And why should we address this problem? Is not so much because we care about rich private bankers and we want to make them even richer, but because the level of profitability and the stock market evaluation are a proxy for banks' ability to generate and retain capital. And therefore, if you want, is the core of financial stability. If banks are unable to restore capital, to generate capital and to maintain capital, that creates a systemic problem that is very difficult then to solve. So I think, and this brings me to the debate that I don't want to touch, but the debate on dividends that is clearly related to this. So shall we allow dividend distribution? Shall we not allow dividend distribution? Is very much related to what we think dividend distribution contributes to stock market evaluation of banks. So maybe let me stop here because I saw that you were already watching your watch, rightly so, and maybe we can have further discussion later.
Many thanks, Elena. I think that we have had excellent points from the three of you. I'm conferring here my notes on the points that we have touched, and also taking as a leitmotif some of the references of Elena to weaker banks. I would venture to introduce a point that I would address to the three of you, which has to do with the public interest assessment. I mean, the evaluation of whether a bank may be wound up under national insolvency proceedings or should be resolved, maintaining its critical functions and protect financial stability. This has originated a big discussion some authors, I recall, for instance, Fernando Restoy, mentioned here the problem of middle-class banks and how are we going to deal with middle-class banks. I wonder if you could react a little to this point, so the public interest test, starting perhaps with Bastian and making a round for the three of you. Bastian?
Thank you for raising these points, and I really appreciate it. Both remarks by Christos and Elena, and I fully share those views. The thing is that what is surprising, and this is something to reflect on what Elena said, how the narrative of the position of the banks has changed since the first lockdown. In the first lockdown, the narrative was banks were part of the solution. Now, entering the second lockdown, but we have started to address the issue of the banks, which relates to, of course, asymmetric shocks across the banking union, different timings, different extents. And then something that which you mentioned now, this all of a sudden the definition of middle-sized banks. I mean, this issue exists for some time already. I think that Fernando has just given the name to it, but for me, I think it is a bigger issue, and this bigger issue is the elephant in the room that nobody dares to address correctly. This is that we have overbanked industry in the banking union. We have more than 3,000 operating banks in banking union, and now all of a sudden, all the banks are so important that we need to stick to each of them. And of course, I think that the point that Elena made in talking about the averages masks the problem. I mean, we have overbanked banking industry. In my view, we are not ready to take advantage of the crisis to sort out the issue. Of course, it's painful. Of course, it's politically the difficult question to address. But again, there are some countries that took advantage of the last financial crisis 10 years ago, did the homework, and there are still some that are lagging behind and kicking can down the road. We have to also acknowledge that in Europe, the banking sector in terms of balance sheets presents over 200% of the GDP in Europe, while in US that measure is below 100%. So we are clearly overbanked. Second, cost-to-income ratios are on averages much higher in Europe than in comparison to around the globe. Meaning that banks are, of course, constrained and then having difficulties with the profitability. And then, of course, the usual scapegoat are low interest rates. But look at the cost-to-income ratios. The cost-to-income ratios in Europe and in banking union are much higher than in comparison counterparties. And then the third point that is for me always a big challenge, and I never really understand and then always question myself about my understanding of the economics and the financial sector is the national fragmentation also in terms of the scope of the banks. I mean, look at the numbers. Cross-border loans in banking union are below 8%, or on average of 6 to 8%. If you take the cross-border deposits, the number is even smaller. So we do have the national banking systems that we are trying to push on European level, but then again, we don't see any consolidation taking place in Europe, and that's why, of course, the discussion about the mid-sized banks comes handy when talking about the potential remedies and support for those banks. And I think that Fernando's point might be misused in this respect, because it is now used for supporting the national actions, instead of taking the step further, raising the bar and start again talking about the European banking system. As I said in my introductory remarks, I really miss the adjective European in all these discussions. We are again, and I think what Elena said in terms of different measures, we have very asymmetric and, at the end of the day, national crisis, potential crisis, which would, in my view and in my understanding of how the politics works, be very difficult to put on the common denominator. And this common denominator might, at the end, be very detrimental in addressing the issues that might come. And one of the points there is, of course, also these mid-sized banks, which in some countries now claiming that they cannot have a proper access to the markets, they have difficulties in complying with all the resolution framework, have a difficulty of optimizing their equations in terms of the profitability, are forgetting the most important postulate in a banking economics of the banking, which is, at least in my view and my understanding of the banking, economies of scales. And in this respect, something that is unfortunately and has been unfortunately overlooked for last 10 years since the last financial crisis, namely the optimizations and something that is called European banking system. Give me one example of any cross-border consolidation in the last 10 years, and I would fully take away all the comments that I made. Thank you.
Many thanks, Bastian. Christos and Elena, quickly your views on this, if possible, also reacting on Bastian's remarks. Christos.
Would you like Elena to go first this time?
Okay.
Okay, thank you, Christos. No, I fully agree with what Bastian just said. I think the fact that we lack a European banking system is crucial. And on this, I think that the potential wave of consolidation that we are going to see is not probably going to help, because the strongest incentives right now are still for domestic consolidation. And here, why? First, because of course, synergies are easier to reach in the domestic consolidation. But second, let's not forget, is because cross-border groups don't simply work. So here we should go back to national supervision and national supervisory institutions that try to ring fence a lot. And this attitude to ring fencing doesn't facilitate the creation of a true European banking sector. So, and that, I think, is another aspect which should be tackled.
Thank you, Elena. Christos, your views?
Thank you. It's always interesting to listen to persons coming from the SRB speaking about the Capital Markets Union. And you think, why are resolution authorities interested about the Capital Markets Union? I think it became clear with the intervention of Bastian before, yeah? Because as a matter of fact, what you said in one of your remarks, Bastian, is that the channeling of funds in the European Union is mainly still based on the banking system, correct? But on the other hand, we all understand that there are some inherent impediments in the deepening of the Capital Markets Union, because you cannot induce capital markets to increase, yeah? So there is a big difference between Central European banking and financial systems and those in the United States or even in the United Kingdom. So I think that for the medium term, one would have to expect that this trend will not necessarily change, at least to the extent that you would have expected. A second point with regard to the consolidation. Yes, of course, and we can use here the famous phrase, I think it was Churchill, who said that never
waste a good crisis.
A good crisis to go to waste. Yeah. So potentially this might be the time when consolidation in the European Union, which obviously is overbanked, could be the time now. But again, under the conditions which are prevailing today, I'm not really sure whether the amalgamation of two problems would create a solution. And the question is which bank could or should merge with which under these conditions. Not to mention about the cross-border consolidations on which obviously the argument raised by Boston and then by it's obvious. Now, answering very briefly to your question, dear Luis, with regard to the application of the PIA, yeah, what you actually asked is the following. Given that the resolution framework allows the resolution authorities to take a decision either to wind down a bank, yeah, to close it down, to liquidate it, or to resolve it, your concern, yeah, is whether under these conditions the possibility would be higher that more banks would be liquidated than resolved. Yeah, this is what I understand is your main concern. But this is for the resolution authorities to decide, yeah, because they have developed, at least since last year, a very analytical approach to the public interest, to the application of the public interest criterion. They have developed the public interest approach, and I would very much doubt whether this approach is not being adapted nowadays. Yeah, I have no internal information, but I think that some kind of adjustment of this approach might be necessary nowadays. On the other hand, we already know that in the 6 cases that the SRB has dealt with, in the 5 cases, the public interest criterion was not there. So the banks have been liquidated. It was only Banco Popular that has been resolved. Yeah. So when it comes to your direct, and to an answer to your question, yeah, I think that this is in the hands of the resolution authorities, and the way that they will deal with this criterion, which is at their, a priori at least, at their absolute discretion. Yeah. Stop it here.
Many thanks, Christos. Let me adjust a little bit our discussion. I don't recall here from my notes if this was mentioned either by Bastian or by yourself, Christos, but there was a mention made to a possible network of European bad banks. And I would like to very briefly have your views on this idea of a network of European bad banks, starting perhaps with Elena and then going to Bastian and finalizing with Christos.
I think, so I am, so maybe let me take one step back before I comment on this. I believe one important point also in dealing with the NPL in this crisis is the recognition that NPL these times are going to be different from the NPLs before. So before, many NPLs at least were real estate NPLs that were collateralized. So it was easier to some extent to use the tool of disposal. And we have seen indeed the flavor, I mean, the flourishing of many of secondary NPL markets in many countries. This time, most of the NPLs will be SMEs NPL, and many of them will be unsecured. So the tool that we may have to use this time may not necessarily be disposal, but rather it would be workout and restructuring, which calls also a challenge for banks, because banks need to have workout units within themselves. And that also is not that easy. I mean, it's something that they have to develop, and this also entails cost and qualifications. On top of that, many of these NPLs will carry state guarantees. So in a way, also the connection and somehow the relationship between the government and the banks will have to be taken into account when trying to recover these loans. So having said that, I think having bad banks is in general a good idea. Probably having a network of European network or national bad banks is probably going to be better, easier to implement probably than a European agency. But we should also not forget another element which we haven't touched upon, which is the stigma that banks fear every time they take advantage of a public measure. So this is one of the reasons also why a lot of flexibility in terms of capital relaxation has not been used by banks, because they're really not very happy of having to signal, in particular the ones that are listed once again. They're having to somehow use something that may make them in a weaker position. So that is also an obstacle, I think, to many of the policies, public policies or regulation relaxation that we have seen.
Thank you, Elena. Christos?
I would fully subscribe with what Elena said, and by extending the argumentation, I would say that the expectations from the creation of bad banks are higher than the expected results. Mm-hmm. There is an expectation that the creation of one bank, one bad bank, pan-European, or a network of national bad banks might be a radical solution to the problem. And in my view, it will not be, for several reasons, including the ones mentioned by Elena. I forget the moral hazard issues which are involved, which are not at this time to be discussed. So, in my view, the creation of a network of bad banks could be a supplementary idea, but it will not in itself resolve the problem, which will remain mainly within the banks. And the question is how this can be mitigated. So, in addition, in realistic terms, one cannot be expect that the NPL bad bank would be created overnight. So this will take time, and potentially until they have been established, the amount of NPLs will have increased, and that's why I'm very, very skeptical on whether other measures should be given priority. Before this network would be operational. I don't believe that it could be in less than 18 months from now or something like that. And if this is the case, then potentially the timing will not be accommodating the expectations. So I fully agree with what was said before, that this is a very good idea, but I would be more pessimistic on the expectations, which are very high on that front.
Many thanks, Christos. Bastian, to finalize the round, your views on this too.
Thank you. As you can imagine, there are different views. Even within the SRB, we have different views in the board about the way forward with the idea of the bad bank. For me, the bad bank is it is part of the resolution toolkit. I mean, it is a separation of assets, and it is one of the resolution tools prescribed, enshrined in the legislation already. And then for that reason, I really find it strange that some are dismiss it up front already and said, look, there is no way to go further. Of course, that will be a process. I mean, even Rome hasn't been built in one day. So I mean, they're just saying, no, look, that is no way forward. It's for me a bit challenging. I fully agree. Workout of NPLs is something that if banks want to do their job properly, it requires enormous energy and resources. There is also a moral hazard. Those who initiated the loans might have a different view than those who are just not emotionally attached to those flows. So for me, the bad bank is something that might decouple this perspective. You know that there are initiatives from the Commission point on secondary market for NPLs. This is again something that in some countries has been already tried, and it never worked because of this lemon issue. I mean, it is asymmetry of information and a lot of politics behind. So for me, the thing is that in terms of the European perspective, I think that the idea is worth exploring. We need to get into it. We need to start working from different angles. Also, because, and then there was mentioned already before, the resolution framework today is designed to work with idiosyncratic events. Also, a public interest assessment is always executed and analyzed in idiosyncratic events. So whenever you have more than one bank, some would claim that this is a systemic event. A public interest assessment gets a little bit of a different notion in this respect. And for that reason, any solution that might help or any alternative, and in this respect, I also take the European or pan-European or system of European bad banks as one potential block in building greater resilience and then robustness of the European system. And for that reason, I do support all the initiatives that would at least enlighten, maybe come up with early warnings that the system might not work. But the worst that I would do at this point is that I will start dismissing some ideas which might at the end of the day at least broaden our perspective on something that for sure worked in some countries, but not in the others. Though, coming back to my point on very little cross-border loans, cross-border deposits, very little of the European in the European banking system. My question on European bad bank might again become more political, also in a sense, who would foot the bill? Because at the end of the day, it's very easy to carve out the NPLs from the balance sheet of the bank, but the bank needs to be capitally strong enough to afford this. And we probably at this point, and I dare to say, not all banks are in a position to carve out the bad loans from their balance sheet at this point, because that would immediately affect their capital structure and put them in different problems in this respect. Thank you.
Many thanks, Bostian. We are concluding our time. We have 1 minute, and we have the Governor Mario Centeno waiting for his keynote address. Just one very short question to Christos, trying to take aboard questions from the audience, which is difficult. But there was a question reacting to your point that the bail-in tool would be a problem in certain cases. Could you elaborate very quickly to conclude on this point?
Thank you very much. My main concern with bail-in, with the application of the bail-in tool, concerns not retail deposits, but mainly the deposits of enterprises.
Yes.
The day that you will bail in deposits of enterprises, if these enterprises, which will be 99% of the cases, would also have loans in the same bank or in the banking system, might become the second round of NPLs. So, and this is what I called the pro-cyclical effect. So in that sense, I would be very cautious in applying this tool if I were to be involved in any discussion on this. You asked me to be very brief. I could elaborate in 15 minutes, but I will not.
Yes, point taken. We unfortunately have to conclude. We would need an extra hour to move forward on several of the issues which have been raised. But I have to thank you, the three of you, for the most interesting discussion and the promise that we will continue in Lisbon next year, this discussion. Thank you very much. Thank you very much to the three of you. And I would immediately now give the floor for his keynote address to the Governor of Banco de Portugal, Mário Centeno, thanking him very much for having found the time in his agenda for this presentation. Thanks a lot. The floor is yours.
Thank you, and good morning. Thank you for the invitation, and thank you, Luis, for putting together such an amazing conference. These are peculiar times that indeed challenge our institutions. The COVID-19 pandemic is more than a public health emergency. It leaves social and economic scars that require coordination across institutions, but also across borders. The financial sector has been acting as a major backstop for the crisis. This also means a yet more challenging future for this sector. Initiatives helping us to be prepared, like this one, promoted by the Research Center on Regulation and Supervision of the Financial Sector, are particularly welcome. This sanitary crisis turned into a severe economic downturn, unbalanced across sectors, and as a consequence, with harsher consequences in some member states. The unprecedented measures and uncertainty led to gloomy economic forecasts. Despite second quarter record-breaking contractions, the perseverance of economic agents led to better outcomes than expected. This is something that we should underline just to remain a little bit optimistic about the future. Indeed, in the third quarter, we observed a rebound in GDP growth, again, better than initially forecasted. At the end of the third quarter of 2020, industrial production, exports of goods, card payments, and energy consumption, just to name a few indicators, were very close, if not above, 2019 third quarter figures. What are the differences between the two crises? The temporary nature and the intensity of policy response in 2020 are my answers. And let's go a little bit in detail on this. Well, the economic developments just described were only possible against a background of a strong monetary and fiscal responses. They were decisive and complementary in supporting the economy and in preserving jobs. Monetary response was prompt and effective, stabilizing the financial markets and preserving favorable financing conditions for all sectors and jurisdictions across the euro area. The asset purchase programs were strengthened and adjusted to the specificities of the current juncture, not only higher volumes, but also by allowing for flexibility across jurisdictions, time and asset classes. The refinancing operations have been providing ample liquidity to the system. Indeed, we must also note that recent medical advances have been favorable, including on the possible use of a vaccine. News in this area are very promising, but we are not out of the woods with waves of virus dissemination ahead of us. Still, risks are high. Their impact may be amplified if the crisis would reach the financial sector. Banks have been part of the solution. This has already been said this morning, not part of the problem. That status must be preserved because there are risks to this, and we have been actively working towards that. The banking system entered into this crisis with an undisputable stronger position than in the financial crisis of 2008 and subsequent sovereign debt crisis. The banking union was part of the response back in 2008. Completion is key to guarantee a genuine economic and monetary union. On the back of the European Single Rule Book Participating countries in the banking union benefit from a consistent application of EU banking rules. Stronger prudential requirements for banks, improved protection for depositors, and rules for managing failing banks, along with the new decision-making procedures and tools, are a guarantee of a more transparent, unified, and safer market for banks. The banking union is a joint effort involving regulators, supervisors, governments, as public support was necessary to preserve financial stability, and also the banks. Work has been hard and progress steady, although slower than desirable. I can be a witness very close and put a very strong and close testimony of that as both finance minister and president in the group in the recent years. The European Stability Mechanism is also a crucial piece of the Economic and Monetary Union. It is a fundamental backstop for euro area member states. Much has already been accomplished, but more still needs to be achieved. Several challenges are ahead of us. The backstop for the Single Resolution Fund has been agreed, but its early implementation is still pending. This is an element of confidence to the system that we must rush to have. It is also of utmost importance to progress on a centralized deposit guarantee scheme. Any mechanism whereby losses continue to be supported, even if partially, by national deposit guarantee systems will not ensure a similar deposit protection across the banking union. The level playing field would be then at risk. Even if the transition phase of EDIS only comprises liquidity support to national DGSs, this is loans that need to be reimbursed at a later stage, it is key not to lose sight of the final goal and to be ambitious on what it should be its final design. The resolution framework, well, this needs some improvements to better fit the features of the European banking system, where institutions have different sizes and business models. Improvements on the resolution regime, changes concerning administrative liquidation, and new efficient tools to deal with the systemic crisis, where several banks might be affected simultaneously, are elements that deserve discussion as they may prove important for depositor confidence and financial stability. The discussion on the consolidation of the banking sector is re-emerging across Europe. The consequences of the COVID-19 outbreak may amplify the vulnerabilities of some institutions, making it more difficult to achieve a return on equity compatible with the cost of equity. Since all options must be considered, market participants will evaluate the synergies that M&A may bring about. However, from a financial stability perspective, in the context of an incomplete banking union, cross-border M&A may pose additional risks. Crises create opportunities to better design institutions, and financial integration would certainly benefit from it. We should actively participate in this process. Our banking system poses many challenges. We cannot avoid them, but I will use the rest of the time today to present remarks on a key fiducial element for the public, the payments system. The COVID-19 pandemic has accelerated its trend towards digitalization. In Portugal, in September 2020, purchases resorting to the contactless technology represented 30% of the card payments purchases, almost fourfold the 2019 average. E-commerce transactions represented 9% of card payment purchases, an increase of 1.5 percentage points with respect to 2019. Such a fast-moving landscape comes with challenges. including for the Eurosystem and national central banks to fulfill their mandate. A smooth functioning payment system is crucial for the conduction of monetary policy and the maintenance of financial stability. National central banks need to act in at least two dimensions, both aimed at ensuring the reinforcement of the European strategic sovereignty. The first is the promotion of a more integrated, efficient, and innovative European retail payments market. The European payment system must be strengthened and its autonomy must be pursued. At the end of 2019, the Eurosystem announced its retail payment strategy. Recently, the European Commission published its digital finance package, which includes a retail payment strategy and a legislative proposal for the regulation of markets in crypto assets, the latter aimed at tackle in particular the so-called stablecoins. Along the same lines, Banco de Portugal has recently disclosed the first national strategy for retail payments, signaling the commitment of different stakeholders in creating safer, innovative, and efficient payments in Portugal until 2022. The second dimension relates to the positioning vis-à-vis private payment systems provided by major global players such as big techs. These companies are well positioned to offer services that might dominate the payments global cross-border market. In order to preserve efficiency and maintaining trust in payments in an increasingly digital society, several monetary authorities, including the Eurosystem, have decided to initiate work on the possible issuance of central bank digital currencies. Should the need arise, the Eurosystem must be ready to issue a digital euro, an electronic form of central bank money accessible to all citizens and firms, aimed at complementing cash, not replacing it. By issuing a digital euro, we could provide a risk-free and trusted digital means of payment. It would support Europe's drive towards continued innovation and contribute to its strategic autonomy by providing a further alternative to external payment providers for fast and efficient payments in Europe and beyond. The introduction of a digital euro would allow the Eurosystem and the national central banks to be at the cutting edge of innovation. However, it will not be without challenges again. In the coming months, the Eurosystem will listen and experiment in order to be in a position to take a fully informed decision on the possible development and launch of a digital euro. Let me conclude. It is too soon to evaluate the long-lasting effects, if any, of the crisis. Will it change consumption patterns? Will it place limits into globalization? Will it foster European convergence and integration? These issues are all at stake, and they have been widely discussed by decision makers and academics alike. In any event, the challenges for the financial system are here, and we must recognize them. And either from a micro or a macro perspective, our ability to respond to them is key to the society's success in the post-pandemic period. This will be our main contribution to this post-pandemic period, and I'm sure that we will be up to it and ready to respond whenever necessary. Muito obrigado.
Governor Centeno, many thanks for your keynote address and your conclusion on a positive note, which I also reinforce with the vow that next year you'll give us again the privilege of another keynote address, hopefully in a physical format. But thanks a lot for providing us an excellent overall picture, and also your most important point on the digital euro, which will also provide food for thought in the afternoon proceedings. We would now, thanking again Governor Centeno, close the morning proceedings, and I would invite everyone to connect again at 1:40 p.m. Portuguese time, 2:40 p.m. Central European time, to start with what I believe will be an excellent roundtable, reuniting the three chairs of the three European supervisory authorities, José Manuel Campa from the EBA, Stefan Mayor from the ESMA, and Gabriel Bernardino from IOPA, leading us to what I think will be an excellent debate. So see you all soon in the afternoon. And I thank again heartily Governor Centeno for having found time in his overburdened agenda to be with us. Many thanks.